All right, let's jump right into this explainer. Today, we're popping the hood on a major player in the financial sector, taking a really fascinating look at the Q1 FY27 financial results for Kotak Mahindra Bank. But don't worry, we're not just going to rattle off a bunch of dry numbers at you. Instead, we're going to use a report card approach. We'll be breaking down how this massive financial institution plays the game by looking at both their offense, how they aggressively drive growth and profitability, and their defense, how they manage risk and actually protect their assets. It is a delicate balancing act, and seeing how they pull it off at this scale is honestly incredible. Here's our roadmap for today. We're going to start with the big picture, look at profitability and growth engines, dive into core banking and deposits, check out asset quality and risk, and then wrap it all up with the final takeaway. All right, Section 1, the big picture. To really wrap our heads around the mechanics of Kotak's quarterly performance, we first have to establish the sheer massive scale of their operations right out of the gate. We're talking about a true financial titan here, and nothing sets the stakes quite like this colossal headline number, 5,480 crore rupees. That is their consolidated profit after tax, or PAT, for the quarter. Basically, this is the ultimate bottom line. It's the net income earned by the bank and all of its subsidiaries after taxes. It's a staggering figure, and it instantly tells us we're looking at a highly profitable, well-oiled machine. Now, profit is great, sure, but in banking, momentum is literally everything. Just look at this jump from Q1 FY26, where the consolidated PAT was 4,472 crore rupees, to this quarter's 5,480 crore. That represents an incredibly impressive 23% year-over-year growth. So this vividly shows us that the bank isn't just sitting back and maintaining its massive size, it's actively, aggressively on the move and expanding its profitability footprint in a major way. So you're probably wondering what's actually driving those profit numbers. Well, it boils down to the pure volume of customer assets being managed and deployed. We're looking at customer assets scaling to an astronomical 645,812 crore rupees. When you connect that massive profit to this staggering milestone of scale, you see just how vast the bank's foundation really is. I mean, every single percentage point of return on a base this huge generates massive real-world wealth. Moving on to Section 2, profitability and growth engines. Okay, so seeing that unbelievable scale brings us to look under the hood at the offense part of our report card. And it naturally begs the question, where exactly is all this profit coming from? Because when you think of a bank, you usually just think, well, deposits and loans, right? But to generate 5,480 crores in a single quarter with 23% year-over-year growth, you absolutely need a highly diversified business model. So let's break down exactly where that money is being made. The secret here is that this isn't just a bank, it's a comprehensive financial conglomerate. Yes, the core bank and other lending entities provide the foundation, contributing 75% of the profit. But check out the rest of the pie. Capital markets are bringing in 11%, asset management and others contribute 9%, and insurance adds another 6%. These subsidiaries give them a super well-diversified growth strategy. So if one sector of the economy happens to slow down, Kotak still has multiple other engines pushing that bottom line forward. Let's dig a little deeper into that diversification. Total customer assets under management jumped from roughly 747,000 crores to over 805,000 crores in just a single year. But look closely at where that wealth is actually expanding. Domestic mutual fund equity alone is sitting at a massive 357,323 crores. Domestic mutual fund debt is nearly 193,000 crores. Plus, you've got insurance, offshore funds, and alternate assets all contributing heavily. This really proves that Kotak is successfully capturing customer wealth across every possible asset class, building deep, sticky relationships with their clients. Which brings us to Section 3, core banking and deposits. Of course, to fuel all that aggressive, offensive growth across those subsidiaries, you need capital, right? Enter the CASA ratio. Basically, this is just the proportion of total deposits held in low-cost current and savings accounts. The higher this ratio is, the cheaper the funding is for the bank to lend out at higher rates. So Kotak's actual CASA ratio right now is sitting at 40.3%. Now, yes, the data shows this is slightly down year over year from 40.9%, but make no mistake, anything over 40% is a rock-solid foundation. It essentially means that 4 out of every 10 rupees deposited in the bank are just low-cost fuel that they can use to drive their lending engines. And here's how that CASA ratio plays into the bigger core banking picture. Total deposits have grown by a really strong 12%, hitting 572,820 crore rupees. Because of that strong CASA foundation, their overall cost of funds is kept remarkably low, at just 4.46%. And since they can borrow money so cheaply, they can lend it out profitably, which gives them a very healthy net interest margin, or NIM, of 4.53%. This is literally the perfect mathematical loop. You attract deposits, you keep the cost of those funds low, and you maintain a wide margin when you lend them back out. All right, switching gears to Section 4, Asset Quality and Risk. Because let's be real, lending money is only half the battle. Collecting it is the other. That brings us to net NPA. This metric strips away all the noise by taking defaulted loans and subtracting cash provisions. So it shows the actual unmitigated credit risk sitting on the books. This is how fiercely Kotak protects its capital on the defensive end. And here is the defensive statistic that absolutely blew my mind. 0.27%. That is Kotak's net NPA. Just let that sink in for a second. Out of billions of dollars in loans, their unprovided bad debt is a tiny, tiny fraction of a single percent. This exceptionally low figure just demonstrates a rigid, highly disciplined approach to risk management. Simply put, they are incredibly good at making sure the money they lend actually comes back. And it gets better when you look at how this builds into their wider strategy. Credit costs are holding incredibly steady at just 0.46% annualized. Now, the crazy part here is the context. The bank has been actively growing its unsecured retail advances. We're talking personal loans and credit cards, which now make up 8.8% of their net advances. Usually, unsecured lending means higher risk and higher credit costs. To keep credit costs this low while leaning into higher yield unsecured lending, that is an absolute masterclass in underwriting. It's kind of like driving a high-performance sports car at top speed while barely burning any fuel. So when we put our report card together, it gives us a pretty stunning contrast. On one side, we have the offense generating a high yield with a 4.53% net interest margin. On the other side, we have the defense maintaining remarkably low risk with a 0.27% net NPA. This just elegantly summarizes the core strategy of Kotak Mahindra Bank. They've essentially managed to decouple the usual risk-reward trade-off, proving that you can absolutely play a highly aggressive offensive game without leaving your defensive flanks exposed. Finally, Section 5, the final takeaway. We've covered a lot of ground today. The massive scale, the diverse profit engines, the cheap funding, and the ironclad risk management. When you step back and look at the total picture for Q1 FY27, Kotak didn't just grow, they surged with a 23% growth in profit after tax. And they didn't do it with one lucky bet, they did it through highly diversified profit pools across banking, asset management, and capital markets. They drove 15% growth in lending advances, acting as a true engine for the economy. And they did all of this while maintaining exceptional asset quality, backed by a provision coverage ratio of 78%, meaning they've already set aside cash to cover the vast majority of their already tiny pool of bad loans. So why does all of this actually matter to you? Well, because an institution functioning at this level of balance represents two really vital things at once. It's a safe harbor with strong deposit growth and super low NPAs. It's a fiercely protected place for everyday wealth. But at the exact same time, it's a growth engine, efficiently deploying that capital to fuel businesses, mortgages, and economic expansion. Honestly, it's a rare dual identity to find in the modern financial landscape. I want to leave you with this final provocative thought. We are always told that high growth requires accepting high risk, right? Well, Kotak has kind of challenged that whole assumption today. So how does this precise blueprint, pairing aggressive, diversified growth with truly fierce risk management, redefine our expectations for the broader financial sector? Should we start demanding this level of dual performance from every institution we entrust with our capital? Thank you so much for joining me for this explainer. Keep questioning the numbers, and I'll see you next time.